know how much when people will die or what percentage of people will die, and we know the coverage, then we can determine how much everybody will pay into that pool, right? To cover for other people in case anything happens. So this is very important because now we actually have a way to accurately represent an industry. Right? Whereas before we're just all sort of paying stuff at random, right? Not really knowing, like, oh, is this too much? Is this too little? Right? It's very difficult to create an industry with that much uncertainty. But with modern actuary science, now there's a certain amount of certainty. That's how this modern insurance industry came about. All right? So let's talk about life insurance in particular. But there are some terms that we probably should be familiar with. Right? The first term is going to be the owner. Right? That should be pretty fairly obvious. He's the owner of the policy. This person determines who the beneficiary is, essentially. Then you have the payor. Okay, this is the person who pays into the policy. Okay? What does he pay? It's a great question. We'll look at that in a little bit. And then, of course, there is the insured. Okay, this is the person whose life is covered. And then we finally have the beneficiary. This is the person who receives the death benefit. Okay, basically, these four terms. Right? The owner, the payor, the insured, these could technically all be different people. Okay? But usually they're the same people. Okay? Usually they're the same people, the families that we're trying to help, right? But they can all be different people. Now, the only thing that we have to be careful about is typically the insured cannot be the beneficiary. Okay? This cannot happen. Why is that the case? Well, if the insured is the beneficiary, we have this problem of the insured passed on, so the beneficiary should get the death benefit, but the beneficiary was the insured, so who gets the death benefit, right? So typically the insured and the beneficiary cannot be the same person. For all intents and purposes, these could all be the same person or different people. All right? Now, what does the payor pay into this policy? Well, he pays what are called premiums. Premiums. It's the amount of money that we put into a life insurance policy. They're called premiums. Right? I got these terms out of the way. Let's take a look at the evolution of life insurance. Ooh, yeah, this is great. Right? Not quite as exciting as the evolution of dinosaurs, but basically the same thing. Right? At the very beginning, we had term insurance. Term insurance. Right? What it means is, I'm only going to cover myself for a specific period of time. 10 years, 15 years, 20 years, 30 years, etc. The maximum length is 30 years. Right? If something should happen in those 30 years, well, then my family gets a death benefit. Okay? And it's mostly for protection. Okay? So inside of a term policy, right, how is the cost calculated? Well, it's pretty simple. Right? Let's say I am age 45. Let's just say I'm age 45. Age 45. Right? And let's say I'm going to get a 10-year coverage till age 55. Or better yet, let's do 30-year coverage. Right? 30-year term to age 75. Well, I know what my cost is every single year. How do I know that? Because modern actuary science, right? Within my particular age group, 45, my particular gender, male, my particular health rating, excellent, not quite, but let's just say there's a certain percentage chance. Based on that, we can calculate how much the cost of insurance is. So I know what my cost of insurance is every single year. I just take all of that costs. Right? I know all of those costs every single year divided by the number of years. I have my annual payment. Right? Very, very simple. And typically, it's the entire term. Right? So very simple. So basically, in terms of a term insurance, right, my premiums equal my cost of insurance. Right? For all intents and purposes, the amount of premium is equal to the cost of insurance that I am putting in. Right? Now, a lot of people will say, okay, well, term is great. Right? Term is affordable. Term is cheap. And that is true. Term is a very, very important part because it is protection. The main reason for life insurance is protection. Right? But term has some problems. And I'll demonstrate those problems right here with this particular case. Right? I'm age 45. Let me clear this, I guess. I can see this. This is age 45. I'm getting a 30-year term. Right? So you can see I start from age 46, and guaranteed my annual premium $2,441. Pretty cheap, about $200 a month. That is very affordable for $1 million of insurance. Right, all the way until age 75, my 30 years. But what if my 30? So I put in the total of $73,000. Okay, but what happens if during those 30 years? I don't pass away, which is the most likely scenario. Well, if that's the case, then I just spent $73,000 for nothing, because my premium equal my cost. This is essentially like your regular car insurance or health insurance or home insurance, right? I pay for it knowing that I'm protected, but I really don't want to use it, right? So I put in $73,000 for nothing. But then they said, okay, I'm 76 and I still want this insurance, right? Well, what is my cost then for an additional year of coverage at age 76? Well, at year 76, my premium is now $101,000. Let that sink in a little bit. In the previous 30 years, my annual premium was $2,441. In the 76th year alone, it is $101,000. 50% more than my entire premiums up to age 75. Right? Well, do I pay this $101,000? Well, it's still worth it, right? Because I'm getting a $1 million death benefit. Okay? What about age 77? Now that yearly premium is $114. Right? At what point does it not make sense for me to pay anymore? Well, that would be age 82. At age 82, I put in more than $1 million for $1 million of death benefit. Right? So term is a affordable insurance, but only when we're relatively young. Okay? Once we get to a certain point, it's no longer that affordable. Right? Who wants to pay $100,000 in premium every single year? Right? But it's interesting because when we pay that low premium, it's because our chance of death is not that high. Right? When we actually need to use it, now we have to pay a lot more. So that's the problem with term insurance. Right? It's because most of the time we probably won't use it, so we waste the premiums that we put into it. But when we need to actually use it, right? The cost is prohibitively expensive to get term insurance. So it was only for protection. Well, people are like, I don't like that, right? I don't want to get something where I waste all this money and never use it. I want to be covered for my entire life. So this new type of life insurance came out, right? 50s called whole life. I'm sure a lot of us, if we had life insurance in the past, it was probably a whole life policy. Okay? Whole life created this concept of, okay, now it is quote-unquote permanent insurance. Okay? But like, okay, well, if it's permanent insurance, we don't know how long somebody's going to live, so how do we calculate the costs? I just did actuary science, they're supposed to know what it costs. Well, it's pretty simple, right? Let's say I am age 45, same 45. Life insurance companies just pretend like everybody lives to age 100. So they take the total cost from age, wherever you're starting, let's say age 45, to age 100. We know the total cost, right? Of that entire period, divided by the number of years here, which is 55 years. Divided by 55 years. That is how much I can put in every single year, right? I'm paying for life. So that's great. Right now we're covered for life regardless of what happens. I will always have life insurance. But this also creates an interesting new twist in that when I am younger, right, my actual cost of insurance is significantly lower than when I am older. But because I'm averaging all of my premium throughout my entire lifetime, right, I'm ending up paying more for insurance at the beginning and a lot less for insurance at the end. So because of this concept, we're putting in more than our cost of insurance at the beginning. Now with whole life, we have what's called a cash value. Because we have our own money, the excess of our premiums minus the cost of insurance. So now in here, right, our premiums, right, is no longer equal to just the cost of insurance. When we put in money, this is actually equal to our cash value plus our cost of insurance. Very, very important concept to understand. For term life insurance, premiums equals cost. For all of these other called permanent life insurance policies, premiums equal to the cash value plus the cost of insurance. We now have a cash value. This cash value is invested into one particular tool, typically very safe tools, bonds. So they get very low growth, right? 3 to 4%. Okay? 3 to 4%, which is pretty good, right? But of course, once there is cash value, then there has to be taxes, right? Once we have some way of accumulating cash, there has to be a way that the government can take taxes, right? IRS loves taxes, right? But they knew this problem might exist, right? They knew this problem might exist. So, in 1913, okay, 2 very important laws were passed. Very important laws were passed. At first, the important one here was 101A1, which basically states that all life insurance death proceeds are income tax free. We protect widows and orphans. How dare you charge taxes to widows and orphans? Right? And on the little side, I said, this is not happening yet, but that cash value in life insurance, 72E, right? Even though it didn't exist at the time, we'll say, you know what? That cash value growth income tax deferred. Deferred, meaning this 3 to 4% interest that we get, right? We do not incur taxes. It is deferred every single year. Okay? So the death benefit is income tax free, and the growth is income tax deferred. So this cash value is now growing at 3 to 4% income tax deferred. Okay? So let's look at an example of whole life. I have the same example of whole life here. It's the same guy. 45. Notice how it's relatively cheap. Right? It's relatively cheap for insurance from age 45 to 75. But after 76, it gets prohibitively expensive. So if you wanted to cover yourself up to age 90, right? It doesn't even 95 is the highest. You're basically paying $8 million in premium, right? To get 1 million of that benefit. I wouldn't call this the best deal to cover our entire life, right? Whereas if you do something like whole life, calculate this. I'm sorry of all these things on here. I wish I could erase them and save them somewhere else, but they're important. If you look at the numeric summary, okay. Now for whole life, right, we're putting in 425,000. This is a special way of whole life. I should probably illustrate the traditional, which is pay out through an entire lifetime. But I mean, this is a more modern version of a whole life. You can put in 425,000, and what do you know? It maintains this benefit, guaranteed, every single year, right? So now less overall premium, right, for the same death benefit. Okay. So yes, term is more affordable in the short term. no pun intended. But whole life, if we're talking about the entire lifetime, it is cheaper. Okay, it is cheaper. Going back to our slides. Okay, now we have whole life, right? But whole life, I have to pay for my entire life. That's kind of dumb, right? What if I can, change it around a little bit? Right? What if I can put in more money at the beginning? Doesn't that help me? Because now that I have cash value growth, right? If I put in this premium for my entire life, right? What if I just concentrate it in the first couple of years? Right? Just concentrate all of that premium in the first couple of years. Why not? So this new evolution came about, and that's the universal life. Okay? Universal life. This U stands for flexibility. Okay? The same sort of cost structure, right? But now instead of having to put in money every single year, right, for my entire life, or as the nationwide example illustrated, every single year for the first 20 years, I can put in even more in the first year, right? And because my investment instruments are the same, and I'm putting more money in earlier, I can expect a slightly higher rate of return. More money in earlier, higher rate of return. Now, universal life average about 4 to 5%. So that's pretty good. So let's look at the evolution so far. It went from pure protection to some cash accumulation, right? Mostly still for protection, to a little bit better cash accumulation, right? Well, with any bleeding-edge financial instrument like this was, there are always people looking to take advantage of it. Right? Always looking for people who take advantage of it. Imagine this. If I were a normal family and I'm using universal life for protection purposes, right, I would just, put in maybe $20,000, $40,000 of premium in order to get $1 million of life insurance. But if I'm super wealthy, what do? Well, if I put the money in, immediately all of the death benefits are income tax-free, and all of my growth is income tax deferred, then as soon as my money gets put into this life insurance policy, all of a sudden, I don't have to pay taxes on it ever again. Right? Now, sure, I can't access the money until I pass away, but once my money is in here, it goes to the next generation completely income tax-free, because the growth is deferred, but the death payment by 101A is income tax-free, so I never pay taxes on it. So how do they use this? Well, I'll just get, $1 million policy, very similar to us, but instead of putting $40,000, we'll put in $5 million. Right? There's no law that says I can't, right? So this created a very unique problem for the federal government. If the point of life insurance, just like Jimmy said, just like Sally said, is to put in a small amount of money to trade for a large amount of death benefit, or to put in a small amount of premium to shift the risk, right, in exchange for a larger protection for my family, that is the point of life insurance. How is putting in $5 million and only having a $1 million death benefit supposed to work? Right? That means that I'm trading a large amount of money for basically no insurance, right? Because I'm getting $5 million instead of cash value already, so I'm trading it for no insurance, which means I don't pay any cost of insurance, and the insurance company doesn't have to pay a single cent, because all of the money is mine anyways when something happens. So it completely disrupted this idea of what life insurance is supposed to be, and it just became a tax shelter. Right? Now, we all know that the federal government is great, but when it comes to taxation and tax loopholes, they clamp down on it pretty quickly, right? So a series of laws, acts were passed starting from 1982 all the way until 1988, TEFRA, DEFRA, TEMRA, resulting in this tax code 7702A. And what that did was it essentially limited the amount. I don't want to get into specifics, but essentially limited the amount that we can put into a life insurance policy, right? it made it so that regardless of what happens, up to a certain age, we have to minimally have some amount of life insurance. Okay? Some amount of life insurance. So it's not completely just a tax loophole. Right? So that's where 7702A. For those of us who are familiar with running illustrations, you'll notice that there is not an unlimited amount of money that we can put in. It is determined by this particular tax code, 7702, right? So the evolution continues like, okay, well, since we've limited the tax savings, why don't we just make it grow better, right? Lobbying, why should we only have to invest in bonds and safe things, right? I want to take that risk. It's my money. I should be allowed to invest in whatever I want, right? Oh, okay, no problem. 1985 came the VUL. Right? This V right here. It's still universal life, which means it's flexible premiums. It's right, but now it's variable, means I can go into the market. This is no longer a general account. There is this concept of a sub-account. Now I am responsible for the risk. No longer the life insurance company, right? So if I want to go into mutual funds, I should be allowed to do that. Okay? And just think about it. This is money that is, of course, after tax, right? Because it's already been taxed. It has tax-deferred growth. Now it's growing at average about 9 to 10%. Okay? Which is great. Now I have this fantastic growth. But the next step is, wait a minute, right? We have a small problem. It's fantastic growth, but I can't use it in my lifetime, right? Because if I take out my own money, that is a taxable event, right? The two laws only say that it's tax deferred and the death benefit is income tax free. It doesn't say if I use my money from it, that is income tax free. So of course, with every single new problem the insurance industry is looking to please, what they came out with is this idea of, what if we don't use our own money, right? Imagine that I'm Bill Gates, right? Or I'm Warren Buffett. Famously, Warren Buffett said that he pays a lower tax bracket than his secretary. And the way he does this is not exactly, but imagine this, right? Let's say I'm Warren Buffett and I needed $1 million in money. Do I give myself a W-2 for $1 million? I mean, I could. It's like I can't. But then what is my tax bracket on that $1 million of income? Probably paying close to 35% of it in taxes, right? But what if I don't do that W-2? What if I go to a bank and I say, hey, bank, I need you to lend me $1 million. The bank says, okay, we can do that. Okay, but we need collateral. Sure, no problem. I'm Warren Buffett. I have all of these assets. We can take collateral. The bank says, okay, but we'll have to charge you interest. Let's say that interest is 10%. Right? Does that make sense? Do I want to pay 10% interest, or because it's a loan, I'm not taxed as income? A loan is not income. No income taxes. So do I want to pay 10% interest on this loan, or do I want to pay 35% in taxes? Right? So the insurance company said this, okay, how about this? Right? How about this? Instead of taking the money directly from your account, which would be a taxable consequence, why don't we lend you the money from our general account? And as collateral, we will take that same portion of your cash value. Yeah, that sounds pretty good, right? This concept of a policy loan came out. Some people have different, sometimes called a preferred loan, some people call it, mostly it's called a policy loan, right? Policy loan does have some interest, typically in the first 10 years. 10 years, it's some nominal amount of interest, like 0.75 to maybe 1%. But then after 10 years, zero. Right? Zero interest. So now what happened, right? Originally, before the advent of this policy loan, life insurance was just for death benefit, for protection. Sure, there's a little bit of accumulation, right? But we can't use it when we're alive. But now, with this policy loan, I put in money that's after taxes. It grows income tax deferred because of this. And when I use it, it's income tax free in the form of a policy loan. What other types of account is funded by after-tax money, grows income tax deferred, and when we use it, we don't pay any income taxes? Anyone? We've gone through investment basics, retirement basics. What is that type of account?
The Roth account.
Yeah, Roth, exactly. Thank you, Sally. So basically, I just created a giant Roth account. How much can I put into my Roth IRA every single year? $6,000. How much can I put into this? Depends on how large the policy I want, right? So in fact, another name for these types of policies, right? These types of new ones with a living benefit plus a death benefit, you'll see them, with many different names. You can be called like a rich person's Roth. It could be called a LIRP, Life Insurance Retirement Plan, right? IGIP, investment grade insurance planning, etc. There's lots of different names for it, right? But essentially, that's what it is. It is a rich person's Roth. It is all of these different types of benefits. Stop. Go into the next slide. Okay. It's like this. There we go. Okay. Right. So everything was going peachy. It was going great. Right? We had the rip-roaring, the 80s, 90s. The market was doing really well. It's like, man, my money is growing so well. In 1997, this new evolution came out called indexed universal life. But the key thing is this indexed. If you guys are familiar with our previous classes, you will know that the index strategy is a way of accumulation, right? Instead of our money going directly into the market, it tracks an index. For instance, the S&P 500. For instance, the NASDAQ. For instance, the Dow Jones, etc., etc., etc. And because it tracks an index, we have some benefits. Particularly, we don't have any losses because of the market, so our money is protected. And in return for that, we have caps. Right? That's the original index universal life. We have caps and a floor. Now, in this time, the markets were growing so well, in the 80s, the 90s, all the 2000s, very little people paid attention to this. Because my money is growing every single year, and on average 9 to 10%, but during that time, it was like 10, 11, 12% year over year. There's the dot-com boom, right? Why would I want to cap my growth? It makes sense, because the market goes up forever, right? Who here thinks the market goes up forever? If I asked this question maybe 6 months ago, answers might be, yeah, it goes up forever, right? But this past 6 months, not so much, right? So yes, the markets can decrease. And so in 2001, what happened to the market? Crash. In fact, we had like 3 years consecutive of not so great markets. What happened in 2008? Another crash. What's happening right now? A lot of people are saying, oh my goodness, it's down 20%, is it crashing? So a lot of uncertainty. So all of a sudden now, this became a little bit more attractive. Right? Sure, we're not going to get that massive growth as a variable. Okay? At least maybe not. But then we don't lose. Right? Index Universal Life came out, around 7 to 8%. This is essentially the evolution of life insurance. Originally just a tool for protection. But as the laws formed, as the product evolved, it became not just a life insurance tool. Sure, the primary purpose of life insurance, of course, is still protection. Nobody doubts that. Protecting our families is very, very important. But now it has all of these other uses. Now life insurance, we could use it for accumulation, cash accumulation, right? We can use it because the accumulation values, we can use it for tax-free retirement. We could definitely use it for that. We can use it for financial aid. Okay. Those are just some of the important ones, but there's so many different ones that we can use now, right? So many different ones that we can use now. So now life insurance is no longer just life insurance. Life insurance is now a financial vehicle, a structured product that we can use inside of our portfolios. But remember, it is still insurance. So there has to be a need. And it has to be planned well. Okay, so let's look at what this new type of tool can do. I'm going to clear the drawings now. All right. Go back here. Everybody, remember what the total amount of premium I put in for my term was before? It was like, if I wanted to be protected to age 100, it was somewhere like $9 million, right? If I look at this whole life, it's $425,000. But now let's look at an index universal life. I have this one. This is an index universal. I'm using an accumulator, right? And I'm going to only put premium for the first 10 years. Perfect. And let's calculate. How much do I want to put in? Now, the amount of premium I'm putting in is, in total, I wanted to put in like maximum 328. 328,591. Now the difference between the two is a whole life is guaranteed. An index universal life is not guaranteed, meaning it is still subject to the market. It is still subject to the market. Right? So this is not a 100% case that it can make it. But what are we illustrating at? We look. We're illustrating at combined, right? Plus, we're illustrating at 5.74%. If we look at the info on these index strategies, what is the average return of these particular indices? Right? Maybe it's illustrating too high. Well, if you look at the averages, the lowest 6.15. These plus that we're using, 9.18, 10.09, right? So it seems like we're being very, very conservative. Very, very conservative. Maybe it's just nationwide that's being conservative, right? Maybe this type of life insurance, nationwide is conservative. What about Transamerica? Maybe they're being very, very aggressive. Let's take a look. Let's look at this. Go back to 45. Texas. Sure, why not? 1 million. Right. We're illustrating here at 7%. Right? 7%. Now, is that too high? Is 7% too high? Let's take a look at the historic. What is the historic? This particular one is capped and floored, right? So it has a current cap of 13.75 if we just do domestic, and a minimum of 0.75%. What is the average? 25-year, 8.61. 20-year, 8.67. 15-year, 8.94. And of course, 10-year, 5-year, and 1 year are all pretty high. So 7%, also very conservative. Right? I would say very conservative. But what about the international one, right? Cap is 15%. It's also illustrated at 7. right? What is my 25-year? 8.95, 8.92, 8.43, 9.48, yada, yada, yada. So it seems like it's also very, very conservative. So what are the chances that by using these type of things, I can reach my goal? Okay? It seems like it's pretty high, right? That 7% shouldn't be something that we are afraid that we can't make, right? Okay, then so now that we have these types of tools, what are some guidelines that we have to be mindful of? Right? How do we use these different tools? Because there's so many different kinds of tools. Right? When do we use term? When do we use whole life? When do we use universal life? When do we use index? Right? Or variable? Well, let's look at some guidelines for these tools then. Let's go back to here. Right? Term. When should I use term insurance? Well, term again is mostly for protection purposes, right? So if affordability. Maybe I can't spare that extra premium that I want to put in. Right? Maybe I don't really need that accumulation. Maybe I just need life insurance for as cheap a monthly payment as I possibly can right now. Well, affordability. Term definitely makes sense. Affordability. One of the main things to go with term is affordability. Second one, maybe some uncertainty. Maybe I only need some temporary coverage. I don't need a giant, right? I don't need a giant amount of death benefit. Right? Maybe my kids are going to be finished school in 10 years. So I only need like a 10-year amount of protection. And then after that, I'm done. I don't need that protection anymore. Right? Maybe that is also a use case. So maybe there's some uncertainty with how long I need that protection. Okay? So definitely that is term. What about whole life? What are some of the use cases for whole life? Oh? One the particular one would be guarantees. Must have guarantees. If we have particular families who just like the idea of guarantees and don't mind paying for the guarantees, maybe not really using it for cash accumulation, but I have to have it guaranteed. I can't take any sort of risk. It has to be guaranteed. Then yeah, whole life can still make sense. It can still make sense. It's not a very high use case for a lot of us here. Right? Because a lot of us here, we design particular tools for uses, and most families are comfortable with a little bit of uncertainty. But if they just must have guarantees, maybe we go with the whole life. Right? Universal life, mostly I would say is not used that often. So the base UL, it's more in terms of these particular tools. Okay? VUL and IUL. When would you use a VUL? If people are want to be hands-on. Some people really want to be hands-on with their cash accumulation. They want to be able to choose their mutual funds. No problem. Right? Has appetite for risk. They like risk. They like the highs. They don't care about the lows. When their cash value grows by 50%, they're exceptionally happy. When it falls by 50%, that's fine. I don't really care. No problem. Yeah. Definitely the VUL use case, want to be hands-on, has an appetite for risk. Right? And by the way, the IUL. IUL is probably why do we always promote the use of index universal life? Because it fits most use cases, right? They prefer to be hands-off. Hands-off. Right? A lot of people, we want passive investments. We don't want something where, it goes up, it goes down with the market. We'd like hands-off. Two. Right? We want to be aggressive, but we don't like losses. Don't want to lose money because of the market. right? And we're seeking long-term what's the word I'm looking for? Long-term gains, but acceptable, I guess. What's the third term? A consistent return. Right? It's not going to grow as high as the variable, but it's going to be consistent. We're looking at consistent between 7 to 9. 7 to 9. Right? That is the time frame that we're looking at. So there's been a lot of development in the index space lately. Right? Originally, index universal life fell into two categories. Right? It fell into two categories. Or one category, and that was cap floor. Cap floor. But as of late, because of the rise of a lot of different things, in the last class we talked about the rise of volatility-controlled indices, right? BCIs, and their use in the RILA market, registered index and annuity space. Well, those BCIs, volatility-controlled indices, are now being also used in index universal life. What those allow you to do is now we can have, instead of a cap and a floor, we can have a PR, no cap floor. A lot of times people say, I kind of like index universal life, but I don't like the cap. The cap is terrible. I don't want there to be any sort of caps. Well, now we have choices to use a no cap floor. Okay? And whereas we saw the cap floor strategy and the 25-year averages of the Transamerica earlier, right? Now in the nationwide, there are new indices. Now, I know you guys probably hope you can get through one class without looking at a spreadsheet. So I'm sorry, I'm going to burst your bubble. Okay? So if we look at the actual return for this particular one, this particular two, and there's a lot of colors here, and it's kind of confusing, right? But these are these sort of new indices. They came out with an index called the Mercury, and multiple different Mercury ones, with and without the 1% charge, and another one called the H factor, from the accumulator 2, that also has multiple ones, but they have a charge. If you look at the backdated history for these indices, you can see that their long-term returns, right? 9.2, 10.5, or 10.05, 11.89. This is for the Mercury, and we look at the H factors, 9.73, 10.61, and 12.53. This is using the actual history. If we compare it to, say, the S&P 500 during that time, right? The S&P 500 compared to the Mercury, because the Mercury only starts in 2005, so we're looking at the S&P 500 from 2005. S&P has averaged 6.49. Okay? If we look at the total returns, a lot of times people say, oh, but you're not considering dividends. Well, this one does consider dividends. Total returns, right? 8.51. Whereas the base Mercury, using backdated data, 9.22. Similarly with the H factor, if you look at the S&P from now, this is 2007 until now, S&P 6.23, S&P total returns with dividends 8.25, H factor 9.73, 10.6, 12.53. Right? So of course these are all within the variability for the S&P 500. So it's not definitively will always outperform the S&P 500. That is not the case. That's not what I'm trying to say. Saying is on the returns, right? We can get similar returns, maybe a little bit better returns, okay, than the S&P the S&P total returns, okay, if we happen to have some major stock market losses, maybe in this environment. Okay. All right, to sum it up, we learned about life insurance today. One of the more powerful tools, right? We learned about how it started just as protection, right? Governed by a certain set of tax codes for that money, right? But then as it evolved, we started getting a cash value, we started getting now flexibility of payment, which is even more growth, right? All the way to it's being regulated by the government because of its taxable consequences, right? Mostly using as a tax shelter, to evolving where we have separate accounts to this index strategy, right? So of course there are many use cases, many different ways to structure these types of tools depending on the types of goals we want to reach. And to learn more about how we can use these goals to use these tools to achieve our individual goals, we can tune in next week when Sam will be going over advanced insurance, right? In particular, how do we use these tools in order to suit our needs? Right? How do we fund them? Right? How do we take money out? How do we plan for different scenarios? So please don't miss next week's class. It will definitely be a new experience. Okay? An eye-opening experience for those of you who've never heard about this. Okay? Right, so that's the content that I have for today for Insurance Basics. And I just realized that I forgot to hit record. So I will not be doing it again. For the next